For the past 2 years, macroeconomic consensus relied entirely on the high-velocity spending of American households to stave off recession. Today, however, that economic engine is definitively stalling. The underlying data shows the economy fracturing into a severely bifurcated K-shaped reality. The downward arm represents a middle-class consumer facing compounding inflation and a severe energy shock. The upward arm represents the high-income demographic, whose wealth is exposed to a tech-driven shadow banking crisis. These simultaneous pressures are evaporating the tailwinds that supported the post-pandemic expansion. For corporate finance leaders, this transition from a consumer-led expansion to a defensive K-shaped contraction is reshaping the 2026 economy. We can see this breakdown starting with the January personal consumption expenditures, which reported a nominal 0.4% increase. This spike was an income illusion. This shows U.S. Treasury Social Security checks, confirming the nominal increase was driven by annual cost of living adjustments, not underlying growth. When we adjust for inflation, real goods consumption actually decreased for the second consecutive month. That January cash injection bypassed the retail sector, flowing straight into household savings instead of driving economic velocity. Low-income households are facing an essential squeeze, where over 60% of all spending is now consumed by necessities like utilities and groceries. To fund the rest, they previously relied on revolving credit cards, but those balances have been sluggish since late 2024, as high-interest borrowing hits a mathematical ceiling. This compounding exhaustion of both real wage growth and credit limits has driven the Consumer Confidence Index down to pandemic recovery lows. Earlier this year, economic models banked on retroactive tax refunds from the OBBBA legislation to provide a sustained liquidity bridge for households. A geopolitical catalyst destroyed that model. The military escalation at the Strait of Hormuz has created a massive maritime choke point. The resulting blockade surged global crude oil prices, pushing domestic retail gasoline past the critical $4 per gallon threshold. Spikes of this magnitude act as a regressive, unavoidable tax directly targeting low- and middle-income demographics. This energy tax strains discretionary income at the pump before those dollars can reach the broader retail sector. By neutralizing the expected tax tailwinds, this shock converts a slowly decelerating consumer environment into a fierce structural headwind. While the lower arm struggles, aggregate consumption has been propped up by the high-income households in the upper arm of the K-shape. This chart shows total wealth distribution. A small 20% block of the population currently holds roughly 72% of aggregate wealth. The stability of this wealth effect is now linked to the $2.2 trillion private credit industry, where high-income capital is heavily concentrated. This specific debt market contains a concentrated vulnerability, a 21 to 40% exposure strictly to software and technology services. The technological catalyst threatening these loans is the rapid, economy-wide acceleration of artificial intelligence, dismantling older tech infrastructures. Artificial intelligence is disrupting legacy software-as-a-service business models, rendering their core products obsolete. Lenders originally used recurring revenue assumptions to underwrite these loans. As customers abandon legacy software, those revenue streams vanish. The technological obsolescence of legacy SaaS is quietly transforming prime corporate debt into toxic assets. As software borrowers see their cash flows dwindle, they are changing how they service their debt. This dashboard tracks those changes. Payment-in-kind income, where borrowers pay interest with more debt, has surged to roughly 11%. On the right, actual default rates have spiked to 6%, with some extreme portfolios hitting 9%. Publicly traded business development companies holding these loans have dropped approximately 16% over the past year. This pressure is now manifesting as a liquidity squeeze. Major non-traded private credit funds are hitting their 5% net asset value quarterly withdrawal caps. These withdrawal caps signal a rush for the exits as institutional capital tries to front-run the spreading contagion. If this private credit stress triggers a broader equity market correction, the wealth effect could evaporate, removing the primary support for remaining U.S. consumer spending. To insulate your balance sheet from this K-shaped contraction, corporate finance leaders are executing a series of immediate operational pivots. First, CFOs in the consumer discretionary sector are abandoning broad, volume-driven unit economics to account for a tapped-out middle-class buyer. Instead, pivot to lipstick effect pricing. Aggressively protect pricing power on absolute essentials while offering high-margin luxuries to a more resilient demographic. Second, corporate treasurers ruthlessly audit their enterprise vendor ecosystems to identify counterparty risk. Signing long-term contracts with highly leveraged legacy SaaS vendors is risky, as their capital structures may not survive the 2026 refinancing cycle. Third, institutional allocators are rotating away from the crowded and increasingly toxic US and European private credit markets. Capital is rotating into infrastructure debt, which offers robust collateral packages backed by tangible physical assets and recovery rates between 70 and 85%. Geographically, allocators are targeting the Asia-Pacific market, which offers more conservative leverage and insulation from the US software disruption cycle. Are you seeing early signs of consumer downtrading in your own sales data? Are you actively auditing your tech vendors for private credit exposure? Proactive assessment of these two factors is the only way to manage the 2026 fracture.